Achmea is a special player in the Dutch market. It's an important player, a player also with strong assets from a strategic point of view, as Willem has indicated. A player that is also able to make a difference, and we want to make that difference by delivering together and by focusing on our customers and be trend-setting as an insurer. In my presentation, I would like to deep dive into the financials, the financial position, as well as the financial plan, which is part of the delivering together strategic plan. At the end of my presentation, there's room for questions, but should there be any pressing questions at this point in time, I am happy to take them. Let me start with my key messages of this afternoon. The base position in the operational result of Achmea is much more positive than what could be implied by the 2016 numbers. And that's the key message. The second one is we have changed the fundamentals of the group for profit growth in future years. And the third one, as already indicated by Willem, delivering together will deliver. And we have an ambition to deliver 600 million result. Obviously, this will drive our free capital, estimated at 400 million in 2020. And this will also improve our financial ratios while remaining strong in terms of solvency ratio. Let me start by looking at the operational result of 2016. This is a sheet already shown by Willem. The basic message is indeed that we reported a loss last year of minus 323, but taking out the exceptional items, our underlying result is 230. The actual items relate to our health business. As shown here, we had a loss of 196. This related to higher than expected healthcare expenses for new medicines, home care, hospital care. And we had a change in our portfolio composition, which impacted the total premium levels. We had an exceptional weather claim, a hail calamity in our non-life business, amounting to 170 after reinsurance. And we had to strengthen our technical reserve for personal injury claims because of three reasons. One of them is we saw clear trends in the whiplash claims. We saw a worsening of the reintegration and a higher number of recourse claims due to the introduction of the WMO. We had a restructuring provision relating to the reduction of 2,000 FTE in our strategic plan going forward. And to be fair, we had an abnormal high investment return in 2016, which related to a change in mandate of our non-life business and the uplift in the market values of the commodity book and real estate. Adjusting for these, again, brings back our underlying result to 230. Our fundamentals have improved, and I would like to give some examples of the improvements over the past couple of years. We maintained our market share in non-life and health. We're market leader, so we kept our premium levels at par and at the same time reduced our expenses significantly. Hence, our cost ratio went down, which is key to our competitive position in those markets. At the same time, we differentiate ourselves by using our scale in the healthcare market, by the procurement of health services and the extension of our health services to the staying healthy concept. We also increased our premiums towards a healthy level, obviously contributing to our profit going forward. And to go into slightly more detail in the non-life operation, we have taken action and shown market leadership. We increased our premiums as first mover in the market. The market absorbed these premiums, and our action was followed by customers. We exited non-profitable business lines, and we lowered our expenses further. And as shown in this table, our combined ratio on an underwriting year basis went down constantly as of 2013, adjusted for the severe weather conditions. This is a positive sign, which also explains the actual soundness of our non-life book. In pension and life, we took the strategic decision to turn our traditional pension and life book into a closed book or a service book. And we still have a small open book for term life, which is growing. For our closed book, we focus on profit and free capital generation. By managing our book and lowering our expenses, our costs, optimizing our capital and focusing on the ALM, the balance sheet management. And as can be seen, our expenses have been reduced significantly. At the same time, we have shifted our strategy towards a new capital light, the new pension market by the retirement services strategy. We have reduced our expenses significantly. Over the past couple of years, the total expense level of Achmea went down with 390 million. That's 15% in 3 years. The FTE reduction amounted to more than 3,000. The main drivers are effectively shown in this sheet. The rationalization of IT, the optimization of our change, the restructuring of the distribution divisions, and the migration to digital all contributed to the lowering of our expenses. At the same time, we have made some tough portfolio decisions. As also announced in 2016, we decided to phase out the servicing of sectoral pension funds, which was a business looking at scale and the inherent cost of the business model, for which we decided to phase out and to stop on the basis of the fundamentals. We also decided to divest our private banking activities. We sold the private banking to Van Lanschot last year, and the remaining activities have been integrating in Achmea Bank. While lowering expenses and divesting businesses, we also invested in the future. We invested in the retirement services strategy, but we also invested in our partnership with Rabo, with the aim to improve the penetration of Rabo clients and, for example, digitize retail online. We optimized our investment portfolio. We improved the fundamentals with, for example, a main change by increasing our investments in mortgages, which increased from practically nil to 6 billion in 2016. And we did that by selling off low-yielding government securities. We also increased our equity portfolio and our emerging market debt. As shown on the sheet, also our derivative portfolio increased. That is effectively a portfolio which we use for hedging purposes, and the underlying value has gone up over recent years, but this is for hedging purposes only. So the fundamentals have gone up. The operational result is much better than what could be implied by the numbers. But what about the way forward? Delivering together has an aim also to improve our profits. And as Willem has indicated, the profit will move up to 600 million operational result in 2020. And this sheet shows the movement of results expected up to 2020. The main contributors being the non-life business, retirement services and health. And as Willem indicated, we expect a normalization of our health results to a margin of 1%, which is 150 million. Hence, ex-health, our ambition is 450. For the life business, our ambition is to generate 200 million operational result. As mentioned before, we have increased our premiums, which are now fully visible in our book. The average premium increase was around 5 to 10% in our book. Also, we expect positive contribution by focusing on claims management, fraud prevention, reintegration, and other preventive measures. And we reduced our expenses through standardization and digitization. This will all contribute to the improvement of our results. Our investment result is expected to go down slightly due to the low interest environment. And Michiel Delvers will give further details on the developments in non-life. Within retirement services, we expect a significant uplift of our profitability, and that's logical because we invested over recent years heavily, which obviously impacted our P&L. Over the next couple of years, we will grow profits within the bank by increasing our mortgages book, our savings book, and at the same time bringing our costs down, for example, by the outsourcing of the back office in respect of mortgages. In the investment management activity, we will increase our investment management, our assets under management, also due to the growth of the APF. And in pension management, we expect a growth as well on the back of the APF development and the existing pension management services. As mentioned before, we have made the strategic decision to convert to a closed book operation in pension and life. And obviously, this will generate significant profits and free capital. During the plan period, we expect that the result will improve up to 270 million. And we also expect that the cost reduction over the next couple of years will be in line with the portfolio decline we expect. And at the same time, we will optimize our ALM to improve our investment results. And these are the main drivers behind the development of profitability in our pension and life book. And obviously, this is a very important portfolio within Achmea from a results perspective as well as free capital generation. In international, there's obviously a mix of investments in future growth. The strategy includes taking the key assets from the Netherlands, the competences we have to international markets and disrupt international markets. That implies investments. And at the same time, we benefit from the investments in the past. For example, in Greece, we have set up a direct operation anytime, and this is expected to grow during the plan period. In Turkey, we see positive development. At the same time, we plan to invest in our IT systems in relation to our banking distribution with Garanti Bank. And also, we expect further currency drops. At our holding, we're also focusing on cost reduction. That is not shown in this table in terms of movement, because this is all allocated to our businesses. And therefore, the benefit is in the results presented for the individual entities. And we expect stable results in our strategic entities as shown on the sheet: Independer, Sintes Achmea, Real Estate and Finance, and Achmea Reinsurance. As mentioned by Willem, in health we expect a normalization of the market, and this implies a premium obviously slightly higher than cost, a 1% margin in our business. At the same time, we aim for a combined ratio or a claims ratio of 96% and a 3% cost ratio. And as shown in an earlier sheet, this is already the level we are currently at. We will still aim at further reduction of our expenses, but obviously this will take some time during the years to come. This translates into an operational result of 150, of which 25 million relates to supplemental health. So that's the story behind the growth in operational result. Obviously, the operational result will drive our free capital generation going forward. And as shown in this sheet, we expect a free capital generation of 400 million. It's important to say that due to the results in 2016, our FCG in 2016 was negative. That's mainly due to the operational result. We also had slight impact from the equity transitional and adjustments in the assumptions for our pension and life business. But the main part is the operational result. If we adjust for that, our base position in terms of underlying FCG is 100 million. And the improvement of profit we see for the coming period will contribute to our FCG and will result in an FCG of 400 million. At the same time, we also expect by 2020 that we will still have the third step in the drop of the UFR. It's the drop from 3.9 to 3.75. Obviously, this will negatively impact our free capital generation, and we also have a phasing out of our equity transitional, which will be finally phased out after 2021. The next slide shows the FCG on a different level, looking at the individual entities. It's important to state that we do not include the FCG or any FCG from the health activities. And that is given the uncertainties around distribution from our health entities. So we have not taken those into account. What is also important to state is that the pension and life business, logically, given the service book strategy or closed book strategy, is very crucial to our total free capital generation going forward. As can be seen from this slide, this is expected to generate, or the pension and life business is expected to generate approximately 330 million free capital generation. The remaining entities will generate 170. Looking slightly deeper into the 330 from pension and life, a key component is the excess return on our investments. We're at 55 basis points above Solvency II curve, obviously generating excess returns. We have, just as any life company, an amortization of the UFR benefit. And due to the fact that we are a closed book or a service book, we have a significant release of our risk margin and our SCR going forward, making a total of 330. And obviously we have our financing expenses. Dividend is not included in this calculation. Then down to the solvency position, we reported a solvency ratio of 181 at the year end. This is a solid position. We looked at the Q&A of DNB. Obviously, this will be included in our numbers as of the second quarter, so it will be in our half-year results. We are still discussing the methodology and the assumptions with DNB, but our best estimate at this point in time is that it will have an impact of -5% on our solvency ratio on a group level. What is also important to note, well, Willem explained the fact that there is draft legislation on the ban of the profit distribution for health companies. That is still draft. He commented on it, but obviously, although the law is very unclear, we looked at the possible implications, and we earlier stated, also during our press conference 2016, that when the full capital amount would be restricted, the amount of our Solvency II ratio would be 25% lower. This is an extreme scenario. where capital supplied by private entities and retained earnings would be not be included, and not just the earnings after the implementation date of the law. Furthermore, the solvency position of our group companies is shown, which is in line with our capital policy, and it shows that we still have headroom left in Tier 1 and Tier 2. In Tier 3 we do not have any headroom at this point in time, and that is due to the fact that the DTAs that we have DTAs on our balance sheet, which are effectively included in the Tier 3 headroom. Then down to the sensitivities. These are shown here on this sheet. Starting with the interest rate sensitivity, it's important to note that we have implemented a further capital hedge in 2017. That is not included in the sensitivities shown here. We have significantly reduced our sensitivity to interest rate. It's also important to note that although there is a -13 impact, the impact of an exclusion of the VA is relatively small. And what is also important, that this table shows that a reduction of the UFR to 3.7 would imply on a group level a -6%. Obviously, the first step is 15 basis points as of the 1st of Jan, and that would imply a 2% drop of our solvency at group level. Looking at the liquidity of the group, obviously due to the results in 2016, we had limited upstream of our group companies. At the same time, we paid our dividend in relation to 2015. We also made investment in subsidiaries from a strategic point of view, and this has reduced our liquidity position. But including our facility, we still have a position of 870. We also have a plan going forward, obviously, which will generate profit and thereby upstream. And we look at other measures to increase our liquidity. And recently we had a redemption of an internal loan of one of our group companies to the group. Then our financial ratios. The profit increase will very much support the rise in our fixed charge coverage ratio. The debt leverage, our aim is to remain below 30 over the next couple of years. And from a capital point of view, the aim is to have a capital position which support our single A rating of the insurance entities and the holding entity with a BBB+. This brings me back to my key messages. The base position in terms of our results is much better than what could be implied by the 2016 results. We really changed the fundamentals for profit return, and we have a strong plan aiming at delivering together a strong increase in our operational result, up to 600 million in 2020, and a free cash flow generation of 400 million. At the same time, improving our financial ratios while having a solid capital position. Thank you very much. I would like to give the opportunity to raise questions.
Yes, good afternoon, Benoît Pétrarque from Kepler Cheuvreux. The first question was on the Solvency II for the pension and life entity, 130. Obviously, there will be some impact from lag DT potentially, and also UFR will come down. So there's quite some risk that this will move down, further down. At which level will you consider to inject maybe capital in this entity? Do you have that in mind, or is that not a discussion at this level? The second question was on the asset allocation. You have been moving a bit the mix, but what type of mix are we going to see in 2020? Are you planning, any investments in more investment in mortgages or other asset classes? And then the last one was on the pension. We see costs coming down very nicely with the decline contribution from the book. Do you expect at some point maybe some issue to lower cost while the book will continue to shrink, basically?
Sorry,
now, are we going to see this trend going forward as well? So lower costs offsetting the lower contribution from the book, or do you anticipate maybe some margin compression at some point in the future? Thanks.
Thank you. In respect of the solvency of pension and life, yes, the LAC-DT also has a big impact on pension and life, which is estimated also at 5%. At the same time, we will have the release of our risk margin and our SCR. So this is just one component explaining the movement of our solvency ratio. We do consider the solvency position of our pension and life company. It's in line with our capital policy, but it's at the lower end. So we also look at additional measures to support this solvency. And that is the actual situation at this point in time.
Which type of additional measures?
We look at optimizing our capital, and there are lots of ways to do that. There's no decision taken yet, but there are ways to optimize our capital going forward. Your second question was on asset allocation. We do expect, obviously we have opted for an increase in mortgages. That also relates very much to the low interest environment. There's still some headroom left there in our mandate. At the same time, we look at the boundaries within the pension and life company, because this is shown on a group level. The mandate is between 20 and 30% in our pension and life company, and we're now close to the 20%. So there's still some headroom left there. In terms of the closed book, we very much aim to reduce our expenses further. My colleague Frans van der Ent will give further details on that. And indeed, the key is that, the minimal is that you reduce your expenses in line with your portfolio decline, but obviously we will aim to do more than that, because that creates significant value and free capital and profits. So we're really focused on that. It's good to say, and Frans will also dive into that further. Our closed book is a pension and life book, so it's not a typical life book with a short duration. It's a long-term book. So another question from Cor, I think.
Cor Kluis, ABN. A question about measures. What's your personal view about longevity reinsurance? I think at your previous employer that was not also been done. What's your view on that? And also selling back books. Is that something you would consider going forward to release capital? Or would you say our size is big enough, so we're not going to sell back books?
Longevity reinsurance is one of the instruments you can apply to optimize your capital effectively. What we do is we constantly review the options in that respect, but we also look at capital cost of each measure. And from our perspective at this point in time, a longevity reinsurance contract is rather expensive from a capital point of view. So that's not on the table currently. And your... the back book. As I just mentioned, we have, due to the fact that it is a mixed book, of pension and life. We have a long duration. And it's quite a large book. And the most value creation from our perspective is in managing this book ourselves and reducing the expenses. As you know, in the market, the market values for portfolios do include quite a significant discount. So from our perspective, it's much better to do it ourselves.
Ian Verveen, UBS. Just a quick question on return on capital. It's obviously not a target that you have. Just back of the envelope, your target 2020 is about 7% of your own funds.
It is.
Your capital generation about 5% of your own funds. So just curious whether you do have sort of internal thresholds that you look at in terms of return on the capital that you apply to different businesses.
Yes, our return is much higher than that in overall level, but obviously the current return is a mixture of a return in our health business, which is much lower, and a much higher return in our other entities, which is above 10, and that is what we aim for.
John Chan from BNP. About the UFR impact on capital generation. So a lower UFR, I thought that would result in a higher capital generation because the amortization of the UFR would be lower. So therefore, capital generation should be higher, isn't it? Because I thought there was a deduction of a lower capital generation going forward because of the lower UFR.
Yeah, that's just a technical component because each year you go 1 year ahead. So there's 1 year there's 1 year deducted and there's 1 year added at the back at a lower value. So that's more the technical calculation of free capital. I'm fully in line with you that it doesn't make sense, but that's the current calculation of a long-term book. So that's why there's a negative. You lose a year which is quite close to you with a high value, and you get a year back which is at a low value at the lower end or at the back end of the book, let's say. Yeah, okay. Any other questions?
Sorry, one follow-up.
Yeah, sure.
And your capital generation guidance of 400 million, does that include the holding cost? Because I didn't see explicit mention of that.
That's on a group level. It does include the holding cost and the financing expenses as well, excluding dividends.
Yeah.
Because effectively your free capital is used for dividends as well as investments in the strategic add-ons to your current portfolio.
Yeah, but it does exclude the health business.
It excludes the health business because of the uncertainty in relation to the distribution of health profits. Yeah. Benoit. Yeah.
Follow-up questions on my side. The first one, just on non-life, are you planning more price increase in 2017 or the coming years? Just wondering. And could you talk about on the retirement side how much AUM growth you are planning on the APF? I think you've put a slide with some profit contribution, high profit contribution coming from APF. I was wondering if you could give us the AUM growth expected, and also could you talk about the margin development on this business, so APF margins. Thanks.
Well, starting with your last question, in terms of growth objectives, for this year we're currently, and I look at Steven, we're above 1 billion assets under management at this point. Sorry? Yeah, that's the asset management company. The question was in relation to the general pension fund. Around 1 billion. Sorry? 1 billion, right? And our target for this year is to grow to 4 this year. I don't know out of the top of my head our target for 2020. Sorry about that. Obviously, it's a margin business. Typically with the margin business, because you need to get volume, it's a fee business. When you reach your critical level, the profit goes up quite significantly. We're not at that point yet, but we will get there during this planning period. And it will be in the second half of the planning period, obviously.
Break even around 2019 or something.
Yes. And your first question, can you repeat that question again for me, please?
It was the pricing on non-life. If you expect
Yes,
more
as
price.
Willem explained, we want healthy premiums in our non-life insurance business. So we do our best to serve our customers well. We're customer focused. We are aiming at not just providing an insurance product, but also services. In the end, we want to make money also on non-life insurance, and that is the key trigger. Obviously, we increase premiums now, and we will continue to look at our portfolio and the performance within our portfolio, and we'll adjust to that. So there's no plan of increasing our premiums generally over the next couple of years with a certain percentage. It's done by managing our business from a customer perspective as well from a shareholder perspective.
Quentin Meyer from DM Clan Partner. Could you say a few words regarding the rating, and is there any current discussion with S&P, and what would be the critical points they're looking at, and what would be the implications for you? What could you have to improve to keep your rating?
As you know, we have a negative outlook at this point in time. There are 3 main reasons for that. The Dutch insurance market, which we cannot really alter at this point in time. The profitability of the group. I think I demonstrated in the presentation that our current plans are really tackling the actual profitability. And we will see a profit growth. And the third element is volatility. And as you've also seen in our presentation, we have, for example, hedged our interest rate risk. So we are reducing volatility. We also look at further measures in terms of volatility reduction. For example, as part of our renewal of the reinsurance program, which is due as of the 1st of July. So these are the measures we take. And obviously we are in close contact with S&P to provide them with the information necessary for them to assess the position. Should there be a downgrade, obviously we will do our best to have an upgrade again as soon as possible. And obviously there's costs attached to that in terms of refinancing our company. But that is inherent in any downgrade. Other questions at that point in time? Maybe later during... Olaf.
Hi. Just one question on the...
Here's the mic, Olaf.
Sorry, hi.
Yeah.
Just one question on the free cash flow generation. The operational result of 170, could you just high-levelly break that down between non-life, retirement and international, just roughly?
There's 50 million on retirement, but it's in my presentation. It's effectively the operational result as mentioned, but obviously for free capital purposes you need to make some adjustments.
Yes.
But the operational result in my presentation is a good estimation of the composition amongst the legal entities. Obviously we have more legal entities in, for example, retirement services, but in total it's easy to estimate. Okay, thank you very much. Steven?